Good morning, ladies and gentlemen, and welcome to the UTILICO Emerging Markets Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to Lead Fund Manager Charles Jillings. Good morning, sir.
Good morning, Jake, and thank you for the introduction. And welcome everybody to our second investor presentation. It seems hard to believe the last one was August, and an steamy summer, and here we are running up to Christmas and in a freezing winter. But let's hope that we can give you some insights and some understanding about how we are positioned and how we are seeing things. I'm joined today by Jacqueline Brewer, who looks after infrastructure, supports airports, toll roads, John Grucock, who looks after utilities, so power, water, and gas, and Jackson John both help me in terms of portfolio manager. They're both assistant, and Mark LaBelle, who looks after communications, so satellites, mobiles, etc. Before I kick off, just to note, last time we spent some time looking at investments that UEM has and trying to articulate to you, if you want, the attractiveness that we saw within them. This time we're going to concentrate on India and Vietnam, two places that the team has just come back from, including myself, and I think we were more than pleasantly surprised about the level of energy, the level of drive, and the level of opportunity for investors, in particular in both those markets. But if I can kick off with a presentation, and I would say to you, to the extent that some of the slides in the back we haven't covered here, do go back to last time's presentation, because I think we spent a bit more time around, if you want, the emerging markets and the opportunity in particular. To remind you, we're long-term total return investors. We'll always stay fully invested. We won't go into cash, but we're looking for that long-term opportunity, and we're trying to look through, if you want, the noise that's in the market. And there is an awful lot of noise, especially at the moment, be it Ukraine, be it China, one COVID policy, but also elections and how they interplay with the markets. We are about active investment. We do spend time visiting and trying to gain a deep understanding of the investments that we have. So our approach, relentless bottom up, is the way I describe it. We're always looking for a new opportunity. We never sit back and accept that the portfolio is perfect. And we always challenge management in terms of how far can they push gross margins? How far can they push growth? Where is the cliff edge, if you want, in terms of capacity? And once they reach it, what's the need to invest for the longer term? As I've said, we are looking for long-term outcomes as predictable as we can find, and with sustainable growth. I think over 95% of, well, over 90% of our portfolio is listed, and that gives us a lot of insight because most listed companies have a rhythm. A number of them publish monthly statistics, but they will engage us half yearly, yearly, and in between while, if they want our views on a particular topic or issue. We're closed end. Under the background, we're closed end. I think that gives us the ability to take those long-term decisions. As you know, there's been a lot of capital flow out of the markets. We're not affected by that, and therefore we can take those long-term investments. Management team, we've got bags of experience, and it always pleases me to see when we come up against investment companies how knowledgeable our team is. It gives us, I think, an advantage in understanding the opportunity and understanding where the challenges might lie. So here's the team. I think I went through last time. We're augmented by Eduardo, who's Brazilian, gives us lots of Brazilian insights. George, who comes from Eastern Europe and gives us a lot of insights into Eastern Europe, especially at the moment. Henry is a new analyst in the UK, and Gillian is a new analyst in the UK, but she gives us lots of insight into China. So we try and understand, if you want, our core markets, but approach it with a specialism. In terms of performance, it's been strong, as you can see. One thing to note on the dividends, we increased the last quarterly dividend from 2 to 2.15p, hence the 8.15p. I think if the board maintains that, there is a clear step up in dividends. It was good to see our earnings per share in the half year come out ahead of dividends, and therefore we continue to have a covered dividend. In terms of market performance, we don't look at, if you want, the MSCI or the wider market. We know all of you at times do ask the question, so we put the information in. But I think if you had to sit down any one of us and ask us to fill in the top 10 companies in the MSCI, we wouldn't be able to do it for you. We just don't follow it. But this is a useful demonstration, I think, of our performance. Just looking at dividends, as I noted, fully covered, paid quarterly. So far this year, we paid first one 2p, second one 2.15p. If we follow through with another 2.15p for the next 2 quarters, which the board has indicated they will seek to do, we ought to come out at these levels. So good progression and good to see. So, as I said, we're going to concentrate on 2 countries that we visited, India and Vietnam, and I'll hand over to John on India.
Yeah, hi, good morning, everyone. I'm Jonathan Grucock. I'm one of the Deputy Portfolio Managers, and I look at the utilities sector. And I'd like to talk to you about India today and why we see it as an attractive investment destination. And I just want to start with the demographics. It's one of the most populous countries in the world. It's the second most populous country. And in the next couple of years, it will actually overtake China to become the most populous country in the world. And the important thing here is it's got a growing labor force. In fact, the labor force isn't expected to peak for another 20 years or so into 2050. And that's because it's a very young population. The average age is about 28 years old. If you compare that to somewhere like the UK, a developed nation, where our average age is about 40 years old. And this is a very literate population. It's the second largest English-speaking population in the world, which of course helps with their interaction with the global community. And what we're seeing within India is urbanization, one of the themes we've talked about previously. Actually, urbanization rate is still very low in India, just 35%, whereas even in somewhere like China, you're hitting 65%. And that's grown very rapidly. If you take the last 20 years, the urban population in India has grown by over 60%, whereas rural population just 16%. And that's because people are migrating to the cities because they want better jobs, better pay, and a better quality of life. And of course, this all requires a lot of investment into infrastructure, which is a thing that we're looking at. And of course, this is an attractive opportunity for us. And if we look at how India has developed, one of the things that's really been driving the country forward for the last decade or so has been the political situation. In the early 2000s, there was a state of what was called political paralysis. Things just weren't being done by government. And then in 2014, the BJP, headed up by Narendra Modi, came into power with a supermajority. And that meant that they could push through some very significant reforms. And I just want to touch on a couple of them today to give you an idea of the scale of them. One of the first things that he sought to do was to bring the poorer rural population into the modern world with digitization and with bank accounts. A lot of them didn't have bank accounts. And so they've now set up over 475 million bank accounts for this rural population. And this has a real tangible benefit, not just for them on the ground, but also in the form of the government getting subsidies through to the poorer population. Historically, they would receive a food subsidy in the form of rice or an energy subsidy in the form of kerosene. But these days, they transfer money directly from the government through to the end user. So it's a fantastic way of transferring wealth through to that population. The second one that they addressed was insolvency. The credit situation in the early 2000s was very poor because there was no real bankruptcy process to clean up credit. And so they put in place a reform which enabled them to get through an insolvency process quicker and to free up capital in the system. And now you can see there that the time to resolve insolvency has more than halved. They also looked at the electricity sector. The electricity sector in India is quite disparate. The states typically manage their own electricity distribution company, and they're typically aligned with the politicians who are in power. And those politicians, they don't want to increase tariffs for users because that will cost them votes. But what that meant is that they were typically running very large deficits, which was then affecting the whole system for having credit availability. And so he's put in place reforms to try and address that and to reduce the deficits that the state electricity boards are running. But perhaps the biggest one was on the tax system. Each state had its own set of taxes, then you had a central tax, and they introduced a unified general services tax across the board, and they cut the corporate tax rate down from 35% down to about 25%. And what they've seen from that is that the actual revenues have increased, but it's also eased up the system. And a good example would be if you had a truck taking goods from Delhi down to Mumbai, which is an equivalent journey of London to Rome. At every state border, it would have to stop, it would have to do paperwork, it would have to pay taxes before it could carry on. So typically that journey would have taken 4 days. Now with GST, that journey has more than halved, so it's only taken 1 or 2 days. So it's just freeing up the economy. And a little bit on the economy. It's a growth economy. Since 2014, right up to COVID, which of course has been exceptional circumstances, we're seeing GDP growth of 7.4%. And just this year, India overtook the UK to become the 5th largest economy in the world. Inflation, which previously had been running very high, again over this period came back to an average of about 5%, so relatively well controlled. This year, we're expecting GDP growth at about 7%, so still very healthy growth. And at the same time, inflation is still relatively high, but they do have a high portion of food in the inflation basket and also energy. They are net energy importers and so have been affected by the high gas prices and oil prices. And this is something that the country is looking to address. They want better security of energy. A lot of countries clearly, this is something in focus today. And so they've been looking at the renewable sector and how they can grow that to address that concern. And they're being very ambitious. Whilst the net zero target of 2070 doesn't sound that ambitious, by 2030, they want over half of all electricity generation to come from wind and solar. And that means that there's going to be a huge investment in these sectors. They're going to have to increase their capacity in wind and solar by 4 to 5 times what they have today. And so that's a great opportunity for us, because if we're looking at the investments that we can make, well, we can invest in those assets, but we can also invest in the systems that are supporting that. And one of the top 10 investments we have is Power Grid India, which is one of the largest electricity networks in the world, over 100,000 kilometers of wires. And they operate the electricity grid for India on a regulated returns basis. So they get 15.5% regulated return, and that's all paid on availability. So as long as the network is up and operating, they garner that return. So it's a very attractive and robust business model. And they were investing quite significantly in the network, which is why we saw good growth. We saw 13% compound annual growth rate in EBITDA pre-COVID. And we would expect, as this additional renewable capacity comes online, they'll be supporting that with new lines, and we will continue to see growth. And this is not an expensive stock. You're trading on 11 times price earnings, and you have a very attractive 6.4% dividend yield. So a lovely investment. And I just want to highlight one of the others that's aligned with the whole push towards renewables. It's actually in the natural gas space, but as India is looking at the general environmental picture, they're trying to get industries off of dirty coal and fuel oil burners. And so in Gujarat, which is one of the most industrialized states in India, we have Gujarat State Petronet Limited, or GSPL. And they're the gas transmission operator. They got about 2,700 kilometers of pipeline. And they're taking gas typically from the LNG terminals through to the consumption centers, so industrial parks and the cities. And here they've been seeing very strong growth in demand. They've seen very robust financials, so growth of 25% compound annual growth rate in EBITDA pre-COVID. And one of the other interesting angles we have here is that it's a very deep value opportunity. They own a controlling stake in a subsidiary, which is the gas distribution company in Gujarat. Now that's also listed. And in fact, their stake in that business is worth more than the entire company of its own market capitalization. So there is a deep value opportunity here. We would like to see in time for that to be crystallized somehow. And meanwhile, we have very strong free cash flow. At the moment, there's a 1% dividend yield, and we think that could be increased quite significantly. And again, inexpensive, less than 10 times price earnings with good growth opportunity. So I'd like to pass over to Jax now to talk about Vietnam. Thank you.
Thank you, John. So yes, I'm Jacqueline Brewers. I look after the infrastructure sector within UEM. So today I'm going to talk to you about Vietnam. So Vietnam currently makes up about 7.2% of UEM's portfolio. So what are the underlying drivers of Vietnam that we like so much? Firstly, like India, it has incredibly solid demographics. With a population of around 98 million, the median age of the Vietnamese population is around 32 years, which again, like India, means that we have a very strong growth in future workforce still to come through. Also, if you look at the age of the population between 45 and 50, which is assumed to be when you are consuming your most in your life cycle, then actually Vietnam has another 10 years of consumption boom still to come. This, as well with the sustained growth of the middle class, which is expected to grow about 10% per annum, are all very strong driving forces to future growth within the economy. The consuming class as well within Vietnam, which is assumed to be those that are spending more than $11 a day, has increased rapidly over the last few years. In 2000, the consuming class only made up about 10% of the population, but by 2030, this is expected to be around 75%. And again, similar to India. Why is this all very good? Well, we should see rising incomes will drive rising demand for infrastructure assets. People would have a higher propensity to consume. Therefore, we need more logistic assets, infrastructure assets, all of which are playing nicely into the UEM's investment remit. The other thing we very much like about the Vietnamese economy is the low rates of urbanization. Urbanization at the moment remains less than 40% of the population. Again, to put this into context, if we look at sort of neighboring countries, China is around 64%, Thailand is around 52%, Malaysia much higher at 77%, and Vietnam is much more comparable to, say, the Philippines at 47%. This is expected, though, by 2030 to roughly be about 44%, and not until 2050 are we expecting to see urban surpass rural. And this shift from sort of agricultural focus to much more industrial and services will help, again, drive future growth. But what really excites me, I think, within the Vietnamese economy is actually the educated, affordable workforce. As we can see from the slide here, the total annual cost per manufacturer in Vietnam is around $4,000 per year. This is 2.75 times cheaper than China. But what is really interesting is if you look at the PISA scores, and the PISA scores are basically a test that's given to students within each country, within English, maths, and science. And you can see here that Vietnam ranks at number 2 after China. So it's showing that we've got very strong quality graduates and students coming through. So we've got a cheap workforce that is very educated. The government is also backing this sort of the drive education. Between 2016 to 2019, public expenditure on education was around 4.2% of GDP, again, second in the region. Malaysia was higher at 4.6%, but the Philippines, Thailand and Indonesia was at 2.6, 3.3 and 3% respectively. And what that's doing, it's really helping to drive the valuation chain. So what do I mean by that? Well, at the moment, Vietnam is very much known for being the assembler of products, i.e. it takes goods, it imports goods, puts them together and exports them. However, as you can see from the chart, like I said, historically, Vietnam has been very high at this, that the percentage of final economic value of goods that are imported is around 50% compared to the US at 8%. But with this very sort of much more educated workforce coming through, we are seeing that there is a rising complexity in the products in which Vietnam is now able to put together. We are seeing this example from Apple, for instance, that have recently announced they are moving to Vietnam to help produce or starting to produce Apple Watches and MacBooks. Foreign direct investment as well into Vietnam is helping drive this, as that's coming to sort of more value products. And foreign direct investment within Vietnam has grown by 61% between 2015 and 2021. All of this drive and the valuation change, of course, will help drive the growth in the Vietnamese economy. Also, as we can see from this slide here, Vietnam is very well geopolitically well placed. Everyone sort of assumes, or historically, that Vietnam is very much linked to the Chinese economy. However, as we can see, they import a lot from China, about 15% of GDP, but actually they're exporting 22% of GDP to the US and to Western economies. Therefore, Vietnam is much more linked to the sort of Western economies than it is to China. We're also seeing from the stringent COVID policies that China has historically, or is still currently slightly put in place, and the supply chain disruptions that we have witnessed over the last 2 years, that a lot of manufacturers that historically may have only produced in China are now looking for alternatives as well as using China. And this is what we'd call the China Plus One model. So seeing companies relocate, again, like I said, Apple is one of those. Vietnam is also number 1 ranking country in the Southeast Asia for trade agreements, making it quite easy to do business there. So what does this all mean? As we can see, these underlying factors that I've spoken about, urbanization, demographics, educated workforce, geopolitically placed, is helping drive the Vietnamese GDP growth. Over the last, since 2011 to 2019, GDP growth has averaged around 6.4%. During the COVID years, obviously the GDP growth has fallen, but you can still see it's positive, unlike many, many countries we are around the world. In 2022, though, GDP is expected to be around 7.4%, and we're going to see a rebound there from COVID-19. And in 2023, GDP growth is expected to be between 4% and 6.2%. Why have we got such a range? Well, part of that is because of economists differing on the view of what they think the global economy will do and how it will perform over the next year. So we can see solid GDP growth, and inflation at the same time has been relatively under control. Over the last 8 years, inflation within Vietnam has been around 2.8%. The Vietnamese government, though, do have a target to keep inflation under 4%, and that has primarily helped to keep inflation low. During the COVID years as well, the government did not print money or spend any money, which has meant that they haven't boosted inflation as we've come out of COVID. Vietnam has also helped to keep inflation low because it has ample domestic supplies. And also, if you look at the diet, I suppose, of the Vietnamese people, rather than importing or having to import grains, which have seen huge price increases recently, the Vietnamese diet is very much based on rice products. And as a result, inflation has been slightly kept down. Inflation, though, is expected to increase in 2022 to 4.4% above the government's target. And part of that is being driven by the same factors that we're witnessing elsewhere in the world, the increasing in fuel prices and demand for commodities such as fertilizer. But what has been going on with the interest rate then? Because interest rates currently sit at 6%. And that has been driven primarily not to control inflation, but by the government looking to protect the Vietnamese dong against the strong US dollar. The Vietnamese dong, therefore, has depreciated about 8% until the end of October. However, it has now actually appreciated back upwards. But this, relative to neighbouring peers, has performed much better. So what does this all mean if we look at the stock market? You can see on the chart that actually in 2022, year to date, Vietnam has been one of the worst performing markets. So why is this? Just like to add, though, you have to see the strong growth that we've seen in Vietnam between 2019 and 2020 relative to its peers. So why has 2021 underperformed? Well, that's mainly due to earlier in the year, the government's clamped down on real estate companies accessing the bond market, as there was evidence that they were raising funds for speculative purposes rather than investment within the property sector. The government, therefore, has kind of squeezed the funding market, and there was concerns very much that the $5 billion worth of maturing debts in 2023 may not be able to be refinanced. And this concern about credit crunch concerns have therefore put pressure on the market. The government, though, has stepped in to try and sort this out and has issued a Decree 65 to help also make issuance a little bit more easier. But it also has cleaned up the market. Given as well that the market itself within Vietnam is very highly retail focused, this has also caused the market to see a bigger drop, because the retail investor is much more short-term focused and I suppose spooked by what they're seeing going on in the retail market. The retail market, just to give you some understanding, makes up about 88% of the total market. And whereas local institutions and foreign investors are only making up 5% and 6% respectively, and they're much more long-term focus. Also, if you look at the Vietnamese index and how it is split between banks and real estate companies, you can see that it makes over 50% of the market. Again, this is therefore causing a much more bigger shift in the index overall as a result. But I mean, I fundamentally believe that what the government is doing is doing the right thing, because in the long term, the regulatory crackdowns and the cleaning up of the fraudulent practices will be positive for Vietnam. They're sending completely the right message to global investors, institutional investors, as well as retail investors, that they want the market to work in a very transparent manner and ensure that all investors are protected. But at the moment, though, we can see within the Vietnamese market, because of the shift in the market itself, it actually provides us with an attractive opportunity. Vietnam now trades at roughly a 10 times PE ratio, the lowest in Asia. And this is down from sort of 17 times we witnessed in a year ago. So it's one of the cheapest markets out there at the moment. And this provides us with opportunities to invest in cheap, deep valued and solid growth companies. And one of which we'd like to now discuss is FPT.
Hi there, I'm Mark LaBelle. I work as a senior analyst on the fund, and I look after telecoms and digital assets. And FPT is a company that we own in Vietnam. We've owned this for a number of years, I think since about early 2019. And it plays on some of the themes that Jacqueline was talking about in her presentation, both domestically, where it's benefiting from the growth in the general economy, and also playing on the themes of serving customers from Vietnam across the world and playing on the high quality educated workforce that Vietnam has, particularly in the IT sector. The company actually is a technological conglomerate, and it has three main areas. The biggest of which has grown is the IT services arm. And as I said before, this is servicing both global multinationals as well as Vietnam institutions like the government and the big utility companies. And its real aim is to leverage Vietnam's very skilled IT workforce, which is priced, I suppose, at about 20% discount to other outsourcing competitors, such as the companies in India. But it's a company that has attracted a very high quality client base. They initially started in more neighboring countries in the region. They're very big in attracting some very big names from Japan, such as Hitachi and Sony and Honda. They've then moved into continental Europe. They've got a number of names of big companies in Germany and France, including Airbus, RWE, and biochemicals. And increasingly, they've been moving into other parts of Asia and into the US, where they've seen spectacular growth, well into double-digit growth in the last few years in servicing US clients. The company, just to give you a sense of scale, they've grown to be over £3 billion in market cap. And in terms of revenues, we're expecting revenues in US dollars to be about $1.8 billion US dollars this year, of which about half will be this global IT outsourcing. And that's a growth of about 20% on what they did last year. The other two main elements of the company are more focused on the domestic market. One is a telecoms company. So this is a fiber broadband company that is growing again into double digits of growth, and they're providing broadband to consumers and companies and data center services. And then in fact, that was what first attracted and got our attention to the company. And the third, which is actually the fastest growing part of the company, is a private education company. So this operates quite a big university with a number of campuses, which I believe John and Jacqueline visited fairly recently, and myself and Charles visited one of their other campuses in 2019. But they also do a lot of technical college education, and they've got their own schools, both primary and secondary school. This is a profitable for-profit operation, but really the company sees education as absolutely necessary to grow effectively the talent base, not only for its own use, but to bring the country right up in terms of education and then growing the country's GDP and development over the coming years. So this is a company that is got a very strong entrepreneurial management team. They've been running for over 30 years. They're targeting growth of at least 20% over the next several years, and we've got the strong confidence that they will be able to achieve that kind of growth rate. But at the same time, it's important to as Jacqueline was saying, to to note, this is also quite a good value company. It's a company that's highly profitable, is growing its profits margins, and is paying a dividend. So although it's growing at a 20% lick, we are getting about a 2.5% dividend yield, and that has been growing at about 20% ever since that we've invested in 2019, and we would consider that is highly likely to continue. So an attractive investment, we think.
Thank you, Mark.
Thank you.
I'm sorry, I was just struggling to get my on button. So I hope that gives you a feel for, if you want, the India and Vietnam where we've been recently. John and I came back from India about 3 weeks ago, and everything on the ground would tell you that the acceleration that they're seeing, especially in our space, is very attractive. So I could see India continuing to increase as a part of the portfolio, and Vietnam. I think we've all been fans of Vietnam for some time, and again, I can see that increasing. To try and answer one of the questions that has come up, which is around EBITDA margin, it's difficult to give you a average for the portfolio because we have a real spread of assets, be they transmission through to airports, and they operate with very different, if you want, gross margins. And as such, trying to give you an average, I think would just be misleading. What I would say is I was very surprised at how well the management teams in the investment companies did in COVID. They all kept a firm lid on costs, and as a result, you saw a jump in margins. So I was pleasantly surprised there. I think out of COVID, if you're looking at this last quarter, most investee companies are producing very strong top-line growth, continue to. And while margins are a bit softer, as you'd anticipate with some of the inflationary pressures, year on year, the increase nonetheless still flows through. So I remain optimistic that we have a good set of managers who can both grow the top line but also control their cost base. So what are we presenting? We, quality cash generative operational assets. Most of our companies, over 95%, are up and running operational. We can, if you want, challenge the management team on their performance and their performance metrics, and understand how they approach challenges that all of them have day to day. And that operational base clearly drives income into us as shareholders. Valuations, as you've heard from the team, they're cheap. I think all of us, if we were pushed, would say never been cheaper. That doesn't mean that you can out them in the short term, but what it does mean is I think we can remain reasonably confident about the opportunities that we've got. Strong management teams, I've noted, experienced investment team. I think our ability to go in and challenge a management team and get to the heart of the opportunity is unparalleled. We've got a differentiated portfolio, and by that I mean we don't look at the MSCI. We are, bottom up, and as a result, we can and do have exposure to places like Latin America, Brazil, and we can have strong exposure to India, Vietnam. What I would say, and again, trying to answer one of the questions that's come up, in terms of liquidity, most of our holdings are fairly liquid. They tend to be quite sizable. They tend to be big within their own, if you want, country of operation, and therefore they tend to be quite liquid. To give you some insight, we turn over about 100 million a year. So we sell 100 million, buy 100 million, and I don't think we've ever struggled with we need to slow down because the cash isn't coming in. If we take a decision, usually we can get there quite quickly. Current discount over 10%. We're frustrated by that. Hard to know exactly what we should do, but part of this process of reaching out to a wider shareholder base is to encourage people to buy, because I think if we can get a consistent group of buyers, then discounts can be brought under 10%. And, one of our objectives is definitely to achieve that. So thank you. And we'll move across to questions.
Charles, that's great. And John, Jacqueline, and Mark as well, thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Jacqueline, as you can see there, we have received a number of questions that have been submitted during today's presentation. So thank you to everyone on the call for taking the time for submitting their questions. And Jacqueline, perhaps I could just hand back to you to chair the Q&A session with the team. If I could just ask you to read out the question and then delegate it out, that would be great. Thank you.
Okay, thank you. The first question that we have received, Charles has already touched upon, I think, is what has been the average EBITDA growth across the portfolio last year and the last few years. Charles, I don't know if you want to add any more about sort of EBITDA growth in particular, but if not, then I will add something about ICT if you want me to talk about that.
I'm quite happy for you to use ICT as an example.
Okay, just quickly, ICT is the number one holding within the UEM portfolio. Just to give you a bit of a feel, what has the EBITDA growth been? This is a port company that operates across the globe. I think it's about 32 ports globally, mainly in emerging markets. Last quarter we witnessed EBITDA growth of 23%. And this port operator has been sort of putting out results like this continuously over the last 3 or 4 years. So I think that gives you some indication of the quality of the companies in which we're invested in. And at the same time as sort of seeing this strong growth in EBITDA, we're also seeing margin expansion as well, which is all flowing through nicely to the bottom line. I don't know if Charles or John, you want to add anything to that one?
I would just probably add, if you took it on average, you're probably getting low double-digit EBITDA growth across the portfolio, because you'll have those higher growth opportunities married with perhaps more stable assets like the transmission assets.
Yeah, thank you, John. Okay, the next question we've got is, do you hold debt in local currency or is it central? I think basically the question, what kind of debt do we hold? I don't know, Charles, if you want to talk about the debt structure of UEM.
So, a pleasure, Jack. UEM has a £50 million facility with Scotiabank. We can draw it in US dollars, in sterling, and in euro. We've been drawn in euro on the basis that we've got a number of Eastern European investments whose characteristics would be nearer to the euro than anything else, and obviously been relatively weak, and it's a cheap currency. So we are drawn roughly 50%, 25 million in euro today.
Okay, thank you, Charles. The next question, we've had a few questions in actually, has been about our discount policy and how we manage the discount. Just to let you know, at the moment, currently the discount for UEM at the end of November was about 15.7%. So again, Charles, I think you're probably well placed to talk us through our sort of discount management policy that we have in place.
So this is probably the most frustrating question I get, in as much as I can't, in effect, wave a magic wand. But, I hope we do the right thing. And what we've been doing is communicating with the market that we want this under 10%. We've been, communicating with investors that it's a cheap portfolio, it's got a good yield, and if you overlay the discount on the top, it's a good place to start. But what do we do in practice? In practice, we've been buying back shares, and when we buy back, we cancel them. So that has the benefit to, if you want, existing shareholders, in as much as it increases the NAV per share and it increases the earnings per share. But it is frustrating. I think, if anybody's got a magic wand, let us know. But we will remain consistently on the front foot, buying back at over 10%. And if you want, cancelling the shares that we do buy back.
Okay, thank you, Charles. Another question we have is, what percentage of the portfolio is in India and in Vietnam? I can happily answer that. In Vietnam, as I was said in the presentation, we're currently 7.2%. India is about 13.5%. And the two countries which rank higher than Vietnam and India at the moment is Brazil at 21.4% and China at 14.7%. Another question we've got is regarding the PE of the portfolio and what it is currently at the moment, or what it has been over the last 12 months, or what is the forecast PE? I don't know, John, if you want to answer that, or...
I think it's something we'd probably have to come back with, because it does move on a day-to-day basis. But it's something we've been looking at recently, because we do get asked this question. But we can come back to the question provider after the conference. Yeah. The last time we looked at it, we were cheaper though than the MSCI Emerging Markets Index. We will come back to you though on that one. One for you, Mark, on FPT. Is there a point at which the weight of the non-utility business lines, such as the IT services or education, can force the trust to divest?
I think it's really one for Charles, really. But I think generally UEM has a fairly flexible investment policy. So it's always difficult when you've got more of a conglomerate company as to whether it qualifies or not. But I think you have to look at the overall attractiveness of the company and its constituent parts, and we wouldn't be forced to look at this, but there may come a point where we find it unattractive. But I think at the moment we're very much long-term holders.
Good answer, Mark. I think, as long as they continue to perform, I think we will continue to want to hold them in the portfolio. In terms of, is there a weighting at which we would be completely unsettled? I'd be surprised, because, the rest of the business is growing and growing quite quickly. And I see that continuing. People like Apple going into Vietnam, they need data centers, and they all need the output of the education. What I would say is, we do look at schools and universities as an investment opportunity. It's not your traditional utility, but if somebody's got a real moat and a real ability to grow both the top line and the profitability, that's attractive.
Actually, as a side issue to FPT, I think Jacqueline was the first person to meet with them back in about 2015. And at that time, they had quite a big import business, which is bringing computers into Vietnam, and also a very big retail arm, which was equivalent, I suppose, to Currys or Home Depot in the US, in Vietnam. And they've effectively divested that. It's listed. They sold the wholesale business to somebody else. They listed the retail part of their business. I mean, they do still hold within FPT Group a small associate holding, but that then meant it was much more focused on the three core elements that are left. Whereas prior to that, the low margin retail element did dominate the business. So when Jacqueline first went to meet them, we would have passed on it. But after that restructuring in 2018, it became more focused towards our areas.
Yeah, I remember that meeting, Mark. Another question, sort of relating to sort of the discount management policy, but I think pinpointing more, Charles, Have we been recently buying back with the recent dip in the share price?
Yeah, we have. I think if you look, we bought back most days. There are moments where I might pause for a day or two, depending on, our shares going X or X dividend, etc. But generally, we've been trying to make sure that we're in the market and buying back.
Yeah, if you look since the end of March results, we've bought back about 11 million shares. So it's quite substantial amounts we've been buying back in the market.
I'll amalgamate the next two questions, and basically it's about how can we determine that the portfolio is cheap at the moment. We say it's cheap as it's ever been, but how can we tell UEM shareholders that it's cheap? I don't know if John or Charles, you fancy taking that one?
Happy to. We cover hundreds of companies within our individual sectors. So across the space, over 1,000 companies, and we're monitoring their progress constantly and their valuations constantly. And so when we're choosing the investments, we're looking for those investments which give us the best risk return and which give us the valuation, whether it's on today's metrics or where they'll be in 3 or 5 years. And we're looking for that double-digit IRR, which can hopefully then develop through the share price as well. If you wanted, how do we then show you it's as cheap as it's been? We can come back and provide some information showing the PE multiples as an example of emerging markets. And so if you took the MSCI EM, it is cheap on a historic basis. And if we then looked at our valuations within it, we are typically cheaper. So we can provide that information. I'm sure that will be in literature forthcoming as well. But we've had over 10 years looking at this market, knowing these companies, and when we're presenting investments which are on single-digit price earnings but double-digit EBITDA growth, I think that gives you a sense of the good valuations we've got here.
Yeah. Just to add to that, I mean, I can totally reiterate what John is saying. I mean, between Mark, John, myself, have all been now with UEM for over 10 years, and we've all covered the same sector for more than 10 years now. So we have an in-depth knowledge of all the companies and also the peers in which it trades against. I mean, I talk about ITT, just number one in the portfolio, but it is probably at one of the cheapest rates as ever, or cheapest level that it's ever been at the moment. And obviously I know what his peers are trading at. As I alluded to in the presentation, Vietnam is now trading at a 10 times PE. And I mean, I looked through the Bloomberg indexes on Friday, and Vietnam is 10 times for the index, whereas, Indonesia, the Philippines, Thailand, Malaysia are all higher than Vietnam at the moment. So again, it means that, where we're looking to invest, these companies are cheap with a lot of value to come. And that, I think, guys, is the last of the questions. I don't know if you guys want to say anything more.
Jacqueline, Charles, John, Mark, absolutely. And if I may just jump back in there, and thank you very much indeed for addressing all those questions that came in from investors this morning. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended for you to review, to then add any additional responses, of course, where it's appropriate to do so. Charles, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Well, I'll jump right in on the last question. I think emerging markets are cheap. I think our assets in particular are cheap. I think that if you see a risk-on environment emerging in the next 12 months, then EM and UEM should benefit from that. I think in the meantime, as I say, we've got good assets, good management teams, good cash flow, good dividends. We can afford to sit still while it comes through and pay you all a dividend. So I hope you stay with us. And for those of you who are not investors, I hope you become investors. But thank you, and very Merry Christmas.
Charles, that's great. And John, Jacqueline, and Mark as well, thank you once again for taking the time to update investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This won't take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Utilico Emerging Markets Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.
Thank you.
Thank
you.
you.